Hello everyone, welcome to our second discussion for this learning module this week, having to do with Chapter 7 and job costing. We introduced the idea of allocating overhead costs. We introduced the idea of what the difference is between what job costing, process costing, operation costing in Chapter 6. Now we're going to dig further into each of those, so job costing in Chapter 7, process costing in Chapter 8, and then we're going to add some other things with regard to allocating overhead in Chapter 9 with activity-based costing. So let's just remind ourselves about what we're talking about with job and what we mean. We gave you the basic idea of the difference between job costing. So when we talk about job, another way to describe it is a project. Some places will call it a project rather than a job. It's what we work on that's easily distinguished from others, customizable for customers, that sort of thing. If we do that, and we utilize that concept of jobs or projects, then we may refer to ourselves as a job shop. Okay, so somewhere in the old days, back when we used to keep this all on paper, there was a job cost sheet. Now it's all, of course, automated, but it serves the same purpose. It tracks the cost of that particular job. So it would be labeled with that job number or letter or name or whatever. And that would keep track of all the direct materials, direct labor, and eventually the allocation of overhead for that particular job. And when people turn in time cards and requisition materials, on each one of them, if your system works right, it should give them an opportunity to identify it by job, and it should prompt them and not let them, without some kind of override, to not put it towards a job. So it should take an extra step if you're going to say, no, I can't, I don't know what job that was. There should be some, something in your system that kind of prompts that to need an extra step, so that does not become the default. And then somewhere in our system, we have these multiple jobs, but when we refer to the subsidiary ledger, it's a list of each of these jobs. So job 1, okay, is we're working on it and such, and that has all the costs, and then there's job 2 and job 3. And if you want to know what your total work is process on, and often in a job cost scenario, we're working on it for months, then we would simply add up, and that's called the subsidiary ledger. If I wanted to know how much work have we done on job 1, 2, and 3, and add that together to see if that's how much is on my balance sheet for work in process, that would be a subsidiary ledger. Okay. Control account is the idea that we need to keep track of things coming in and out. Most of the time, a control account, things are going in and out, and we are really, if there's something left in it, then that indicates we need to do something out of the ordinary. We usually make an adjusting entry or something. It may even indicate that there's a problem with our system. So we're working at the production process at a fictitious company, Gupta. We manufacture furniture, okay? So this is customized enough that this is considered job costing. So as we look at materials, out of raw materials, out of our warehouse, we pull those materials out that are direct materials. And what we mean by direct materials now in a job cost environment is those that we can specifically say are used for a job. All right, so if they were asked to be used on that particular job, all right, then that is a direct material. If it is something that's used for the factory in general, then that's indirect materials and goes into overhead. So you can see it becomes a little clearer a little bit when we start to say this is a job cost scenario, what a direct cost is and what an indirect cost is. Direct materials, direct cost can be, you can say, I need this. I can identify and trace this material to that particular job. All right. If I put it in a bucket and all the people working on jobs can pull from it, it is an indirect material. Same thing about labor. Okay. Direct labor are the people we can specifically say are working on that job. And they're filling out a time card, whether that's electronic, whatever, however they're doing it, may be completely automated, but they still have to indicate what job they're working on. If they are doing maintenance, if they are doing supervision, and they're not, can't trace that, that's indirect labor, and that's going to go into overhead. Okay, so there's your kind of graphical of both the two direct costs as opposed to the indirect. And then you have your other overhead that are not, okay, indirect labor, not indirect materials. You've got a whole other parts of overhead that need to be allocated to the jobs at some point, typically at least monthly. If you've got a long project that's 4 or 5 months, you may allocate overhead multiple times. For shorter jobs, you may only do it once, maybe even not until the job is completed. But we're going to allocate using that predetermined overhead rate we learned about in Chapter 6. So that whole idea is going to carry over here, and we're going to use it again here with job costing. So we're going to trace how this works in our T accounts through the inventory. Okay, so the first thing that we want to do is look at what we have when we start the year. So our direct materials inventory is $30,000. That would be on the debit side of our T account. That's called raw materials inventory. We have one job that we're working on partially done, job 1203. Okay, we've worked on and done and completed $41,000 worth of costs for that job on January 1, but it's not done yet when we start the year. And then we have some stuff in finished goods. Now, in job costing, most of the time your finished goods is pretty minimal because jobs are usually customizable by customer. And so as soon as you're finished with it, you know what the customer is and you sell it to, it doesn't sit on a shelf for very long. Now, occasionally you'll have a job that you do the whole way and then the customer backs out or something like that. But normally the time in finished goods is very short in a job cost environment because the customer is known before you even start the job in most cases. So looking at the journal entries in the T accounts, okay, you can write them out as debit and credit. You can see them here in the T account to see the track the balances. We're going to buy raw materials. We're going to debit inventory. We're going to credit accounts payable. Bought it on account. If you bought them for cash, it would be a credit to cash. We use direct materials. So we took it out of the warehouse, and when that happened, we identified these as being used in a particular job. So we credit materials inventory or raw materials inventory, all right, and we debit work in process. Now, I want you to focus on the bottom part, the subsidiary accounts, because the work in process inventory on the top right is really just a summary of the three work in process accounts below. And if you get them correct in most systems, then the top one will be right. Okay, so we put 12,000 in work in process for 1203, 102,000 work in process 0101, and 15,000 work in process 0102. Again, that would be indicated by the requisitions that were asked for by those in charge of those jobs. They said, this is the stuff I need on this job. That across, if you add those across, is the 129,000. Same thing with labor. Okay? We got $98,000 that we owe to our employees, wages payable, and we're going to debit work in process for $98,000, but really what we're debiting is work in process 1203 for 16, work in process 0101 for 71, and work in process 0102 for 11. How do we know what those are? We're going to have time cards. We're literally going to track that in the computer, which job employees are working on, so that when we pay them, we can actually allocate it to the job accordingly. Okay, so far we've just done direct costs based on time cards, based on requisitions showing what was used. Now, we got to deal with overhead, right? And so during the month of January, okay, we had these actual overhead costs. The actual overhead cost should be a debit to our manufacturing overhead control. Okay, they say MOH control. You don't need to include control if you don't want to. Okay, when you're doing it for me, that's what it'll be when you do your homework for the textbook. But the key thing is you understand that there's this manufacturing overhead account. Things are going in, and remember, control account going in and coming out, all right, and we expect it to basically end up zero, all right, and that's what we expect for this manufacturing overhead control. Right now, these are the costs that go into overhead. The credits depend on what type of cost. So if you're using up insurance, you're going to credit it prepaid. If you're using machinery, you're going to credit accumulated depreciation. If you're utilizing indirect materials, they're going to come out of your materials inventory with a credit. When you pay, have your bills for utilities, that's going to be a credit to accounts payable. And then indirect labor is going to be a credit to wages payable. But I'm most concerned about, now obviously we want our journal entries to balance, that you know what the debit here is for actual costs of overhead. Now we're going to use that concept of predetermined overhead rate. Remember, we came up with it before we even started because we don't want changes in overhead costs in one particular month or week to change how much we calculate. So we need to calculate one rate, okay, for each type of cost at the beginning of the year, or at least the beginning of the accounting period in some way. Okay? So we did that. We estimated the overhead for the whole year would be $600,000 and the direct labor cost would be $1.2 million. So remember, that was something we did predetermined. It doesn't directly relate to those journal entries we were making a minute ago in terms of actual costs. Okay, this was the estimate before we started any jobs. We use direct labor costs. Not my favorite way to allocate overhead, but it gets the idea so that you can see what we're doing here. This is the formula we learned about in Chapter 6. Okay, so our predetermined overhead rate is 50 cents for every dollar of direct labor, or 50% of direct labor costs, however you prefer to think about it or calculate it. So if job 1203 has 16,000 of direct labor, now remember, this is separate. This is in addition to the direct labor. It is not instead of. All right. The direct labor costs 16,000. Then the overhead that we are estimating that they used on that job is 8,000. If their direct labor was 71,000, then we're estimating their overhead was 35,500. So if you allocate overhead multiple times to a job, make sure that you're only allocating it for the hours that you use, or the direct labor cost since the last time you allocated. Don't double allocate, okay? So if you allocated for 10,000 direct labor costs last month, okay, and now you've spent 20,000, on direct labor, don't allocate for the whole 20,000, but only the 10,000 you've used since the last time you allocated. So in this case, these were all of our direct labor costs. This is how much was allocated. So how do you journalize that? You credit the manufacturing overhead control, okay, and debit the work in process. So notice that every work in process has to have what? Maybe could have beginning balance, but doesn't have to, but it has to have direct labor, direct materials, and an allocation of overhead. You cannot have a totally drop cost until you have dealt with all of those three things, okay? And so we've allocated that. 43,000 goes here, and the 5,500 goes there in work in process 0102. So two of the jobs, and it's usually pretty easy to know. We have a just definite start and stop on job costing. So we know when we're done. So when we're completed, then we move them to finished goods. How do we know what to move, how much to move? We simply add up the costs that we have been tracking by that job. So job 1203 started with 41 that was partially done. That's how much we had left over from last time. And then we had used our accounting to get 12,000 for direct materials, 16,000 for direct labor, and we had applied overhead of 8,000. So our total cost was 77. You see here the same thing for job 0101, except we had 0 to start with. This was a new job, okay, in January, and we had obviously a lot more costs for this job. It was a bigger job, okay? So what we need to do with these costs, we know that job 1203 costs 77 and the job 0101 costs 208,500. We simply credit the work in process inventory and debit finished goods inventory. Okay, notice they made it separate for each job. Some companies will do it together and just make one journal entry. Doesn't matter. Okay, then we're not quite done, right? 2 jobs were sold. One that was already in finished goods, had been completed as of January 1st, and the other was one of these 2 jobs, okay, that we completed during January. They were sold, and the sales was 35 and 95 respectively, okay? So now we're going to take the job that we know the cost of, 27,000 for the one job that was there already when we started this whole thing. And then the job that 1203 we know is 77, right, from our finished goods, and going back to this whole schedule here where we calculated the cost of 77. That stays with us. We know that. Our system's tracking that so that when we sell it, we record it as cost of goods sold of 77. We debit accounts receivable or cash, depending on how the arrangement is made, and credit revenue or sales for those 2 sales. Again, we could do it in 2 different entries if we want to keep track, okay, and make it real easy to trace, or we could do it together in 1 entry. Then when we're done, okay, this is what we should have in our T accounts to start February. Okay? Materials inventory left over, work in process, the job that we're still working on, finished goods, the one that cost us and we finished but we didn't sell yet, and we know what our cost of goods sold is for the month. This is kind of the idea of what we're going to track. Nobody's going to do it this way anymore. It'll be all electronic, but it would have the job, would have maybe the customer, You'd have a date started, especially if you've got stages and you need to keep, you may even have a schedule of which stage is being done for each week or things like that. Okay, you've got when did they ask for materials and how much. You can see a list of the direct materials requisitions. You can see all the detail of the various employees and their time cards that worked on it, and then your allocation of overhead, especially if you did it multiple times. If you did it each month, maybe this was a project that lasted 2 or 3 or 4 months, then you may have overhead allocated multiple times. So there's our job cost for 0101. It was transferred to finished good inventory but was not sold. Okay, so that's why it's still in finished goods inventory. Remember, that doesn't happen very often. Most jobs are sold right away after being finished. All right, so then let's get to the last concept maybe that we need to worry about. And while we're going to apply it to job costing, it applies to process costing to any system where you have allocated an estimated amount of overhead. So remember, we've also recorded as we've gone along the actual overhead. So we had our estimate and we used that to apply overhead to jobs, but we also have been keeping track of the actual overhead costs. Okay? And so we get to the end of the accounting period, typically the end of the year. All right? And then we compare and we see if the actual was more or less than what we applied. If it was more, then we have under-applied overhead, and if it was less, then we have over-applied overhead. So let's look at our example. We have to make this, again, we have amounts going in and out, and we need to make it 0 at the end of the accounting period, typically once a year. Okay, so we see these were all those actual amounts, debit, and this was what was applied. Remember, it was applied using 50% of direct labor cost to our 3 jobs. All right, we don't want to do this all the time because you're always going to, these are going to always be off, right? You're estimating and you're comparing it to actual. And each month there's going to be differences. And so one month we may be more with, and more or less, and the other month will be the other way, and so forth. And they'll kind of offset each other. And we don't want to constantly be trying to do this until we reach the end, but we have to do it at the end of the accounting period. If that's a year, that's typical for most companies, unless there's something really unusual happening. But we see that our actual, now this was as illustrated with just a month, but it would typically happen at the end of the year. All the actual costs on the debit side, overhead applied on the credit side. We have more debits than credits by $24.50. That is then under-applied, right? We didn't apply as much as what actually happened. So at the end of the year, to make our manufacturing overhead 0, we're going to credit it for $24.50. So when it is under-applied, then we're going to credit and we're going to debit cost of goods sold. If you remember, you just got to make it 0 and the opposite side goes to cost of goods sold, you'll be in good shape. Now, most of the time, our over or under-applied overhead should be small enough to not be material, and therefore it doesn't really matter where you put it, and so cost of goods sold is a good place to put it. Sometimes, if it's significant, you may want to split it between work in process inventory, finished goods, and cost of goods sold based on a percentage. So if you have more costs in finished goods inventory than cost of goods sold, than work in process, then you would put more of your over or under applied overhead, okay, based on those percentages. And you see how that would work out here. All right, that's somewhat unusual. Now, while you can estimate and things, you can do this on using actual or a standard. We'll learn more about standard costing a little later, okay, in our semester. But people use job costing in various ways, in combination with other pieces that we will learn later. Now, a little bit about what if this often service companies, hospitals, architectural firms, accounting firms, law firms, they will operate in at least a sort of job costing scenario, okay? They don't have significant direct materials. That's one of the big differences. Most of it is labor and overhead, but they still need some way to allocate that overhead to the services. They charge for the direct labor rate, but they also charge for overhead. Often called, instead of cost of goods sold, cost of services billed, or cost of revenue, or something of that nature. But it has the same principles, just missing the direct materials. All right, so here's how that labor might look. What ethical issues might you run into with job costing? I would say the biggest one here is the stage of completion is probably not a big deal, okay? But charging costs to the wrong jobs, typically to make you look better as a manager. So if you can get costs that should have been for your job charged to a different job, then you're going to look more profitable and more effective. That's a problem. If you're using the cost of the job to bill customers and you're actually putting a job cost from one job to another, then the customer that's going to get the additional cost is going to pay more. And that would be unethical. And that would be an issue. So that typically is putting something on the wrong job. And again, it can happen because of a mistake. All right, just oversight. What we want to try to have internal controls on is to make sure we don't want it to happen by mistake, but we also don't want it to be in a situation where someone can manipulate the system to make it look like their jobs cost less, is typically the issue, okay, for whatever reason, because of unethical behavior. And then just the idea that project, I use the term project and job interchangeable. Your authors often say, a long job is a project, okay, but we're not going to make too big of a differentiation between those two.